Good day, guys. In today's video, I'll be teaching you one of the easiest ICT strategies out there. Now, when I mean easy, I don't mean it's the most profitable strategy. What I mean is that it is the easiest strategy to execute, especially if you are just coming into the ICT space or you are just a beginner trader. Then I feel like this strategy will be the best place for you to start from. Now, this strategy doesn't require daily bias, it doesn't require higher time frame analysis, and it also doesn't require overthinking. That is why I feel like it's really good for beginners. We are only going to be using two time frames, the 15 minutes time frame and then the 3 minutes time frame. And also the concepts we are going to be using is also very minimal. We are only going to be using market structure and fair value gaps. Now, market structure will only be applicable in the 15 minutes time frame because we just want to use that to understand the structure of the market. And then fair value gaps, we would also use it in the 15 minutes, and then that would also be our entry confirmation in the 3 minutes time frame. Let me show you a graphical representation of this. So let's say this is the 15 minutes time frame and we have this break of structure. This is clearly telling us that price wants to continue pushing lower. And right here, you can see the price left behind a bearish fair value gap. So what we are going to be expecting is for price to come back into this fair value gap to then continue lower. So what we are going to do first is wait for price to come back into the 15 minute fair value gap. Once price comes back into this 15 minutes fair value gap, that is when you then go down to the 3 minutes time frame and you look for these two entry patterns. Now, let me explain each entry pattern individually. So in this entry pattern, what I want you to watch out for is for price to displace below the last bullish candle. So as you can see, price came back into this 15 minutes fair value gap and then it displaced below this last bullish candle, leaving behind a fair value gap. And also in this example, price also displaced below this last bullish candle, leaving behind a fair value gap. Now this is where our entry would come. Our entry will come at this fair value gap, then our stop loss would be at this level and we'll just target a 1:2 risk to reward ratio. Very simple. Now this is the checklist we are going to use. So first of all, we will go down to the 15 minutes time frame and get a 15 minute fair value gap. Then we wait for a 3 minutes displacement above or below the last opposing candle. What this means is that if you are bullish, you would wait for price to displace above the last bearish candle and leave behind a fair value gap. Very important. And if you're bearish, you need price to displace below the last bullish candle and leave behind a fair value gap. And then your stop loss should be at the previous swing point, just like I explained in the previous slide. So your stop loss should be at the swing points that created that fair value gap. And then your take profits would be set at a 1:2 risk to reward ratio. So after you get your entry confirmation, which is this entry pattern, and then you have this fair value gap, your entry would be at the top of this fair value gap. Your stop loss will be at this swing point, and then you target a 1:2 risk to reward ratio. Now let's go to the chart so that you can see a whole lot of these examples just happening in this month of March. So this is the first example we are going to go through. This is Euro USD, the 15 minutes time frame, and this happened on the 3rd of March 2026. So first of all, we can clearly see that price is bearish. Price has been breaking structures to the downside. Now right here, we can see the newest break of structure to the downside, clearly showing us that price wants to continue lower. Now, price left behind two bearish fair value gaps. So we will wait for price to come back into one of those fair value gaps before we then look to go down to the 3 minutes time frame to then look for our entry. So let's play price forward a bit. Right here, you can see price clearly reacted from this bearish fair value gap. So we can then go down to the 3 minutes time frame to then look for our entry. And in the 3 minutes time frame, we can see that this was the last bullish candle. And as you can see, price has closed below the last bullish candle, and it did so impulsively, leaving behind a bearish fair value gap. So this is the area where we should be looking to take our trade. Our stop loss will go above the swing high, which is this swing point, and then we will target a 1-to-2 risk to reward ratio. Now let's play price forward to see what eventually happened. And exactly, as you can see, price tapped back into this fair value gap and then hit our 1-to-2 risk to reward ratio. Now let's go into the next example. This example right here happened on the 4th of March. As you can see here, we had a break of structure to the upside, and then price left behind a 15 minutes fair value gap. So the first thing we are going to do is wait for price to come back into this fair value gap. Then we'll go down to the 3 minutes time frame to then look for our entry. So here, price has come back into the 15 minutes time frame. So let's go down to the lower time frame. And in this lower time frame, what we are looking for is for price to displace above this last bearish candle. So here we are seeing displacement, but price hasn't given us a fair value gap. So let's play price forward again, which you can see here, price just left us a fair value gap. So we'll take our entry from this level. Now our stop loss goes just below this low, and then we target a 1-to-2 risk to reward ratio. So now everything is set. All we have to do then is just wait for price to do its thing. And as you can see, this trade was also a take profit. So within 2 days, you would have actually made 4% just using this simple strategy. Now let's go to another example. So this exact one happened just a day after. So as you can see, just very similar. We have a break of structure to the downside, clearly telling us that price wants to continue lower. And then price left behind this bearish fair value gap. So we'll be anticipating the price will come back into this fair value gap before then continuing lower. So what we are going to do first is wait for price to get back into this fair value gap in the 15 minutes time frame, and then we'll go down to the lower time frame and look for our entry. So right here we have seen the price has come back into the 15 minutes time frame, and this was also a very lovely rejection. We had price try to close above the 50% of this fair value gap, but then closed back below. So now when we go down to the 3 minutes time frame, the first thing we can see is this was the last bullish candle. And as you can see, we would want to see a displacement below that last bullish candle. And this candle has already given us a bearish engulfing candle, but that's not all. We need to wait for the next candle to give us a fair value gap. And then we'll be looking to take our trade. So right here, this next candle actually gave us the fair value gap we were looking for, or we were anticipating for. So what we are going to do is we are going to take our entry from this fair value gap. Our stop loss just goes above the swing high, and then we target a 1-to-2 risk to reward ratio. So now let's play price forward and see how this trade played out. And here you can see that this trade would have actually been a stop loss, right? Right here you can see price just tapped us out, and it has actually started moving to the downside again. But this is also a very good lesson so that you would understand that this trade doesn't win, or this strategy doesn't win 100% of the time. But also when you look at this level again, you would see that price gave us a last bullish candle, and then we had a displacement below this candle, and price actually left a fair value gap. So this can be used as a re-entry. So here we can take our trade from this level. Our stop loss goes above this high, and then we target a 1:2 risk to reward ratio. So now let's play price forward and see how this other trade played out. And as you can see, this one was a take profit while this one was the stop loss. And within 3 days, from March 3rd to March 5th, we have been able to take around 4 trades just using this simple strategy. And 3 of them were winners and just 1 was a loss. So you should have been up around, let's say, 5%. And this is how good this strategy works. And as you can also see, it doesn't necessarily have so much thinking in it. Once you see a break of structure, you see a 15-minute fair value gap, you go down to your lower time frame, which is the 3 minutes time frame, and you just wait for price to displace below the last bullish candle and leave behind the fair value gap. Very simple. Now let's go over to the next example. So this one happened on the 12th of March. And as usual, we first have a break of structure to the upside. Then price left behind 2 bullish fair value gaps. So we'll be waiting for price to come back into one of these fair value gaps before we can then start looking to go down to the lower time frame to get an entry confirmation. So let's play price forward. So here you can see the price disrespected the first bullish fair value gap. So we can delete that one. And here you can see the price has come back into this other bullish fair value gap. This is when we can then go down to the lower time frame and wait for price to displace above the last bearish candle. So let's play price forward a bit. Okay, so here you can see this was the last bearish candle and we had a displacement above this last bearish candle. So price left behind this fair value gap. So this is the area where we will take our entry. Our stop loss goes below the low and we target a 1:2 risk to reward ratio. Now let's play price forward and see how this trade played out. And as you can see, take profits was hit. Now I want to also show you another example. Let's just play price forward. This happened in the 15 minutes time frame. Okay, so we had, let's take price back to this level. We had a new break of structure to the downside, or you could call this one a market structure shift. And then price left this fair value gap, this fair value gap, and this fair value gap. So what we are going to do is mark them out and wait for price to react from one of them. So let's play price forward. Here you can see price reacted from this one, and then gave us a bearish hammer candle. Right, so this is when we can then go down to the 3 minutes time frame to look for our entry. And right here you can see this was the last bullish candle. Price left behind this fair value gap. So we can look to take our entry from this level. Stop loss above this high, and we target our usual 1:2 risk to reward ratio. Now let's play price forward and see what happened. And as you can see in this one, price didn't trigger us in, price didn't tap our entry, and it has hit our take profit. So once this happens, what you're going to do is you close your limit order and you wait for the next trade. So let's go through another example. So here we have another example. This one happened on the 17th of March, and here you can see we have a bullish fair value gap. But now I want you guys to look at this closely and tell me if something is missing. Because yes, we do have a bullish fair value gap, but do we actually have a break of structure to the upside? We don't. So this is not supposed to be your trade, right? You should always wait for every single checklist to be played out before you can take your trade, right? And I also want to show you something, right? Because a whole lot of traders might see things like this and think this is their setup. So as you can see, price clearly rejected from this 15 minutes fair value gap. And then when you go down to the 3 minutes time frame, what we are going to be looking for is a displacement above the last bearish candle. So let's just play price forward. And here we had that displacement. This was the last bearish candle, and we had the displacement that left behind this fair value gap. So this should be where we should take our trade. Our entry will be here, our stop loss at the swing low, and then our take profits would be set at a 1 to 2 risk to reward ratio. Now let's play price forward and see if this one still played out. And yeah, you can see this trade played out, but this is not still your setup. That's what I want you to understand, because a whole lot of traders would see this and say that it played out, and then they would say, I could have still entered it. No, right? Because if you continuously do something like this, you would most definitely be losing, and you most definitely be emotional when it comes to this. That is why I want this to be a very mechanical strategy. If everything is not aligned, you are not allowed to take the trade for you to get the best results out of the strategy. Now, this is where you should be looking to take your trade. So let's play price forward. Okay. So in the 15 minutes time frame, now you can see break of structures to the upside. And price did what? Price left behind a fair value gap, this fair value gap right here. So let's mark out this fair value gap, and then let's wait for price to come back into that fair value gap, because this would become our setup if we then get our lower time frame entry. Okay, so right here you can see the price has come back into the 15 minutes fair value gap, and we can also see that we had a break of structure, or you could call this a market structure shift to the upside. So this is a valid setup. So we can then go down to the 3 minutes time frame and then look for price to displace above the last bearish candle. Now, when we look at this bearish candle, the price displays above this last bearish candle? No. So what we're going to do is wait for price to come back lower and see if we are going to get another entry, because this didn't give us an entry. So let's play price forward. Now, right here is where I want you to look closely. So as you can see that this bearish candle, think it's lower or very close to this last bearish candle. So we could use this, right? So we could use this as our last bearish candle. And after that, we saw what? A displacement that left behind a fair value gap. So this is our potential trade. This is the one that aligns perfectly with our checklist. So we are going to take this trade, stop loss below this swing low, and then we target a 1 to 2 risk to reward ratio. Now let's play price forward and see how this one plays out. And as you can see, this one still hit take profit. So this is a lesson I would really want you to understand. Always try as much as possible to follow your checklist, even though sometimes trades may play out without everything aligning, but that isn't your setup. You always need to wait for your own setup to form, wait for every single analysis, wait for every single checklist to be completed before you then look to take your trade. That is how you get the highest probability when it comes to your trading setup. So I hope this makes sense. So on that note, we have come to the end of this video. If you enjoyed the video, please give it a thumbs up and subscribe. And also, I created a PDF version of today's teachings. So if you're interested in it, just click the first link in the comments to download it. And I'll see you in the next video.